short-term rentals and stuff like that. That's
okay. Here, let me interrupt. So it's 8 o'clock. Let's get ready to roll. It's Tuesday. Jason Hebert here. He's with Trustmark National Bank. He's a bigwig in there. He's here to talk about mortgages, lending, what's going on, state of play generally with what's going on in the mortgage industry. He was just talking about, because I know a lot of listeners here, people who tune in are from all over the country. Jason, quickly, lending's lending, Arizona, Florida, New York. Is it all the same?
It's all the same generally. There's going to be niche products for particular markets. Resort areas are going to have more specific niche products for short-term rentals.
Held in-house?
Those are all. So you have your basic Fannie Mae, Freddie Mac, conventional loans. Everybody knows what a 30-year fixed is. You're buying a primary residence or a second home or investment property that's usually a single family home or a townhome with a loan amount that generally is going to, in most markets in the United States, there are high dollar markets that is different, but generally 95% of the United States is going to fall into conforming loan amounts dictated by Fannie Mae, Freddie Mac that are loans below $766,200.
All right, Jason. So I'm going to ask you, what is the state of play in the mortgage industry right now? Are mortgage rates going up? They going down? They're going to be flat? What are we doing here?
So the long-term forecast, and by long-term, I think, 12 months out.
Okay.
We're finally in a position where the prognosticators and the pundits do think that this time next year, there should be some relief. Now, that's always just a forecast. Right.
What is some relief? Like 8-point drop?
So no, I would say about a 1-point drop.
A whole.
Again, it's just rolling the dice and making a judgment call based on what's going on right now. Economic reports are.
What is going on? What is the rate? What is it? If I was to say a normal rate, what is the 30-year rate right now?
30-year fixed rate mortgage on your typical primary residence home is generally in the high 6s to 7%. The last 30 days, we've seen them as high as 7.25, as low as 6 3/4.
Okay.
Now that's with no points. You're not buying down the rate, so you're not paying anything extra for a better rate. But
the run-of-the-mill loan,
the run-of-the-mill loan, 6 3/4 to 7.25 over the last 30 days.
And what were they, say, 2 years ago?
2 years ago, well, 2022 is when everything started to change. So beginning of 22, you were still talking about 30-year fixed rate mortgages in the 3.5 range.
So they're double still.
They are double that. And between January and basically June of 22, they went from 3.5 to 6.5. And since then,
That's
to now,
an affordability problem.
It's an affordability problem. Absolutely, it is.
Because at the same time, home prices, the physical house, doubled.
Yeah. So you're still dealing with elevated prices. You're still dealing with elevated rates. So it's the big question is, which one of those or are both of those going to give anytime soon? Because the biggest problem we have right now in the primary residence market, not necessarily an investment market, because those folks are looking for a return on their investment. And that can be a different animal based on, what they can get for rents and so forth. But in the primary residence market, it's a significant affordability problem in our area and across the United States generally.
Okay. All right. So the state of play right now is they're high. Can you get a loan? Are people getting loans? Is it hard to get a loan?
So it's not any more difficult to get a loan. It's more difficult to qualify. So you have somebody
who kind of call that all of a sudden.
All right. So here's a good example. I use this all the time. Somebody buying a primary residence, putting 10% down, doing a $500,000 purchase price. They're doing a loan of $450,000. In the beginning of 2022, when we were at, say, 3.5, that mortgage payment on a monthly basis with taxes and insurance, somewhere $2,700 to $3,000 a month.
Okay.
That same mortgage payment with taxes and insurance included, also with the consideration that taxes have gone up a little bit and insurance has gone up significantly, that same mortgage payment is $4,000.
Yeah.
So somebody
people are borrowing.
Well, it's Can I qualify? We have certain
because we're talking
debt to income ratio is the biggest issue. You might have great credit. You might have the money to put down. It's really can you qualify? A regular debt to income ratio that's generally accepted for most agencies is around 45%. Of your gross income. And that takes into account all liabilities that are on your credit reports, car payments, student loan payments, minimum credit card payments, and your housing payment. So you got somebody, and let's say they make decent money. Let's just say decent money is, for ease of the calculation, is $120,000 a year. Okay.
Yeah.
So that's $10,000 a month.
Okay.
That means that on their outgoing debts, they can be a maximum of $4,500, or they don't qualify basically. And so when
doesn't take long to get there.
Well, when you're buying a $500,000 house and that's mortgage payments $4,000 a month, that means you can't have a car payment that exceeds $500. You can't have credit card payments that are excessive. So it's with the regular everyday person, and not that $120,000 is bad income, but it's like you have to afford to have other bills and buy a $500,000 house. You have to make $200,000 these days. That's the underlying issue. If you have no other debt, it's a lot easier, but that ratio comes into play every time. And that's,
so if rates come down, say they come down in September, quarter point.
Yep.
That improves affordability.
So what the Fed does and what the mortgage market does are very kind of loosely related, not significantly related.
If the Fed lowers the rate, the mortgage rates don't necessarily go down.
That's right. So the idea is that when the Fed lowers the rate, that also the yield on the 10-year Treasury, which is kind of the benchmark in the mortgage business, also comes down with that. Then yes, mortgage rates will come down as well. But the underlying issue is that if the Fed does something that's not expected, that's when the 10-year Treasury market goes haywire. If they say, hey, we're expected to go down in September, and they don't go down in September, then all of a sudden the Treasury market goes haywire, and it might go up 25 basis points. And, instead of having a cut, we have an increase.
Is that what happened when they said they're expecting 4 rate cuts this year, and so far we've had 0? Yeah.
So basically from the beginning of the year, we have stayed very static in that high 6s to low 7 rate range. And at the beginning of the year, the prognostication was that we're going to have 4 rate cuts: March, July, September, December, usually 25 basis points each time. Now, the economic reports have come out, and they've been very, very wishy-washy lately. And so instead of having rate cuts and the natural somewhat lowering of mortgage rates, we've just stayed exactly where we are, because the economic reports are, hey, inflation is being tamed. It's down. Oh, next month we get one. Hey, inflation still looks sticky.
Because the housing is sticky. The rents are high.
Rents are high. Housing is sticky.
Unemployment's held up.
Well, I'll tell you, at least in my opinion, and from, the folks that I listen to, the biggest problem with rate cuts is that most economic indicators are saying that inflation is being tamed to an extent. Personal consumption and the consumer's still buying. But the unemployment rate is still very good. It's the Fed generally wants everything to be negatively affected before they make a call on a rate cut. And there's something that in there and in those reports that the Fed gets and talks about that, hey, we got A, B, but we don't have C, so we're not going to cut yet. And that's really what's happened, is the mortgage rates have stayed sticky because there's been no real action on everything else.
Not anticipating a big drop anytime soon.
I don't. I think, like I said, my hope and from the folks who talk about this, but it's all just it's a stab. It's a wild guess, is that, this time next year, if we're at 6 3/4 right now, hopefully we'll be at 5 3/4 this time next year.
Let me ask you something. Let's say it gets to 5 3/4. Does that move people?
It does. It does. Oh, yeah. I think once we get, I think it's a mindset.
Yep.
A 5 or a 6 or a 7 are different animals.
Yep.
Something in the 5s.
Just on that mortgage payment every month.
Well, the mortgage payment, you're going to save $300-400 a month by having a payment that is based on a rate that's lower than it is right now. So it's real money.
Yeah. So point will matter for sure. Okay.
So I've got a question.
Sure.
Go ahead. Well, the question is there's a lot of talk of the changes in the country around buyer brokerage agreement.
Yeah.
And what latitude may be coming down in terms of allowing that commission for the buyer agent's commission to be rolled into the mortgage when it deals with appraisals.
Right. I don't expect that. The only, and we're getting very little guidance on that. The agencies that we rely on, Fannie Mae, Freddie Mac, HUD, VA, those agencies really, they're more reactive. That's just their natures. They're more reactive than proactive. At this point, generally, the only guidance we've been given is that basically that can be paid by the seller and it's not considered a concession. But, as far as rolling that into a mortgage, I think
that's going to have appraisal issues.
Yeah. I mean, there's issues out there that we don't know about that could surface, and then we're going to have to address those on the fly. The main thing that at this point, because the guidance we've been given is only that, hey, it doesn't have to be a seller concession if they pay for it, which whoop-de-doo, is that, perhaps somebody who's generally, and just using a primary residence transaction as an example, somebody who is planning on paying 10% down, hey, we'll have to switch them into a 5% down product. It's just going to be the nature of having to deal with those on a reactive basis. And what do we do about that?
So
that's
what's
interesting.
The max?
Yeah, go ahead.
I said, so what's the max in terms of FHA, VA, conventional, the different products? What's the max contribution that a seller can make towards a buyer's?
Yeah. So on a conventional loan, it really depends on the loan to value. So if somebody's buying a primary residence, putting 5% down, 3% is the maximum concessions. If they're putting 10% down or more on a primary residence, it's 6% concessions. On FHA, they don't generally limit that. On VA, they limit it to 4%, but there's some rules around that are very flexible. On investment property transactions, it's only 2%. That's the only place where you really get to a point where you got to really manage the concessions.
It's almost getting to a point where a DSCR loan is cheaper than a regular loan. I've heard that.
Well, so it's dependent. So DSCR loans are generally going to be done on investment properties, right? Mm-hmm. So we're talking about primary residence rates right now. Mm-hmm. So, we're at 6.5%, 7% on a primary residence. On a conventional mortgage, single family home that's an investment property, and you're putting 20% down, your rate's over 8 paying points. With 25% down, it's in the high 7s paying a point. So the DSCR loans generally are going to be, at this point, what I've heard, I don't offer those products, but I have friends that do. They're 8.5 to 9.5.
Okay.
So hey, for somebody who needs that to qualify, I probably get 2 phone calls a week where I go, you need to call this person because you don't qualify for what I do. Hey, for me, it's about,
but what I
can't do it and somebody can, I'm sending them to the person who can do it.
But what I hear is seller, basically the commission as a seller concession does not count towards those allowed.
That is correct. And that is, generally what my advice has been on that is that, yes, things have changed. This lawsuit created just hectic stuff we've got to deal with. But at this point, I believe very strongly that it's going to be based on the conversation that the realtor has with their buyer at the very beginning of the process to ensure that they know whether they have that money to pay the commission or not, and negotiate the contract based on the seller paying if they do not have that additional money. So, I usually discuss the money. That's not generally what most realtors do, but you're going to have to get comfortable discussing money up front because that's potentially a huge expense if the buyer is expected to pay that.
There's going to be some bumps in that road. Is that fair to say?
There's going to be some bumps in that road. 100%.
Destiny, what are you seeing with your people? Yours are all cash because you're a high flyer, but still.
That's it. That's the goal. No, what I was going to ask you is when I'm making my calls, the biggest thing I hear is I want to wait till after the election. I want to see what the election does.
Right.
And so, what is your most generic, without getting into political views or anything
Sure.
like that? What is your understanding of how that's going to play a role in?
Well, I do not believe politics really plays into a lot of the mortgage market in general. And I say that because, you do hear, oh, rates are going to come down if the Republicans get in, stuff like that, where, Trump's already said that he wants to keep Powell on. Powell's the one controlling the Fed, and I think he's doing a pretty good job. It's
I would
really
agree with that too.
It's really a matter of the Fed is as apolitical as it can be, and their job is just to tame inflation. I think it's ultimately not about who's in office, but those economic indicators flashing the right way for everybody. So I don't think that makes a significant difference. I'm not of that opinion.
That's an excellent point for our realtors out there that are wanting to win the day, because they get that as an objection all day long. And that's an uneducated person thinking that that overnight, come November 8th, everything changes in the housing market. But that's not the case. That's an excellent point.
It's not the case in my opinion. I mean, I think the Fed's done as good a job as they can being apolitical. And this is really about them trying to make sure that a loaf of bread doesn't become $15. I mean, ultimately, it comes down to that. And I think that it's about time that they begin cutting. There's been whispers about, hey, if you wait too long, then you're not doing your job by balancing it out fairly. If you just wait for everything to happen that you want to happen, so hopefully we'll see that sooner rather than later, because generally most economic indicators are lagging by 12 to 18 months. So
it's the rents that's holding everything up.
Yeah, rents are definitely something that are impacting that.
All right, so let me add. And here's the other thing: it's insurance. The mortgage rate is just one piece of the mortgage payment, right? That insurance is a killer.
So the insurances are probably, besides the rates, and that's just news that we have to give people on a daily basis, breaking down, hey, how much are you coming to the table with as far as cash out of your pocket, and how much is your payment? Those are the two things that everybody wants to know. The most pertinent part that is the unknown at this point is their insurance. And on every transaction that comes my way, even if it's just, hey, I'm kicking tires and I'm looking at this house, I've got an insurance contact that I reach out to and go, hey, how much is the insurance is going to be on this house? And we get a good ballpark. Sometimes there's inspections, whether it's, wind mitigation or a 4-point inspection that's going to be required to confirm it, or, hey, we need to know the age of the roof. We need to know the age of the water heater. But there's wild swings in the cost of insurance. You get a new home in the same location that might be $2,400, and you get a home that was built in '89 in the same location that might be $8,000. So getting that number can affect the amount of their payment on a monthly basis tremendously.
It's harder on the insurance people. You have replacement costs are so much higher than they were. Homes are so much bigger. I mean, my insurance back in Omaha is only this. Of course, you live in a 2,100 square foot house or 1,800 square foot house, whatever. Here, you're buying some big old mansion. So, Jason, let me ask you this. Our buyers out there, what do they need to do to start the process so that it's easy? Because I hate getting a lending.
Hey, I'm the first one to say.
Because I'm an unorganized fool.
Mortgages suck. They are not fun.
How can people streamline it? What should, if I'm looking for a loan, what should I do?
Best thing you do is talk to a lender and get an idea early, way before you're thinking about contacting a realtor. Honestly, you should contact a lender, because hey, we don't want potential buyers wasting your time if they can't buy what they intend to buy. But it could be somebody who's self-employed who, wrote off everything in the kitchen sink 2 years ago, and their taxes show that they made negative $20,000. And we need to go, hey, you got to pay the piper at some point. So let's strategize to make this happen next year for you. It could be people who have, some minor credit abrasions who need some advice on how to fix those to get in shape. It's people who, hey, I'm getting some inheritance and I'm getting it in 6 months. Okay, so let's look at everything and make sure that you're ready to go and you know what you're dealing with when we get to that point. But
okay, so here, let me ask you something.
Yeah,
we talk about getting your team together, right? Whoever it is. Would you agree, Jason, that a realtor should find a lender or 2 or 3 that they can count on, and before you go out and start showing property and dealing with anybody, push them to the lender if they're getting lending, obviously, and make sure that like all that stuff you just said is in play before we even start the game. Does that make sense? Do you have realtors out there that call you up, Jason? I'm about to enter this. Can you talk to me?
Every single day. That's that's where you have to start. And I know that there's that rule of 3, but find that one, because that
somebody can deliver.
Somebody who can tell you what's going on and tell the buyer
Honestly.
what's going on, honestly and directly. I mean, I make sure that those folks get off the phone with me. I've been doing this way too long to leave them with questions hanging out there. They get off the phone and they know exactly what they're dealing with.
And when it's so much better, because now the realtor knows you're going to find something that you're ready, willing, and able to buy.
Yeah, don't find 3. Find 1 or 2. 3 is just going to confuse people because they might talk to 3 people and get 3 conflicting opinions, or, hey, I talked to 3 people and this guy has the best rate, but I couldn't understand a damn thing he was saying.
Yeah.
You have to be able to explain everything in layman's terms to people who don't buy a house and do a mortgage every day, and explain to them, hey, what is debt to income ratio? Somebody might go, hey, your debt to income ratio is 57%. Well, people don't know what that means. Hey, just like I explained it to you earlier, somebody who makes $10,000 can have $4,500 a month going out. That's a 45% debt to income ratio. And what counts in that ratio is your housing expense, including taxes and insurance, your minimum credit card payments, your car payments, student loans, stuff on your credit, not your cell phone bill, not this and that and the other. So it's being able to find somebody you trust. I mean, I generally have great rates, but I'm not going to tell you there's not a lender that out there somewhere that may, but I will also tell you, I don't expect there's a lender out there who is going to get off the phone with me and have
Jason's doing
questions.
one of ours right now. Let me ask you this: to win the day, that's what we're doing here. Win the day. What would you say agents should do from your perspective to win today?
It all comes down to listening, but from a winning perspective, I mean, a win for me is not wasting your time. Right.
Okay.
So the first move, besides asking, hey, what are you looking at? Are you looking at a condo? You're looking at a house, primary residence is an investment purpose. Get them to a lender who's going to direct them and set their expectations right. If I have somebody come to me, they're buying a condo, they expect their payment to be $3,000 a month, and then I tell them, hey, your HOA dues are $1,200 a month here, and your total outlay on a monthly basis is going to be $4,500. Hey, you don't want to waste time with somebody who wasn't willing to spend that.
Okay, so to win the day, when you guys get off this call today, take a few minutes, figure out, if you don't have a lender right now, figure out a lender. How do you find a lender?
Well, if you've had a successful transaction, whether you've been on the buyer side or the or the seller side, and it went smoothly, call that person. Call that person, and it's not going to be Rocket Mortgage. It's not going to be, online lenders. It's going to be somebody local, somebody who has a broad suite of products. Hey, I want you to reach out to this person. This is who I want to come to you
with my people. Will you do it?
Or yes. I mean, ask those persons the questions that you would want to answer, have answered if you were the buyer.
So when you leave here today, just get off the call, or when you watch this, whatever, just take 10 minutes. Think about your deals you've done in the past that had lending, that went smoothly, that you like. And then what? Write down that lender or 2 or whatever, and then call them and say, hey, I'd like to establish a relationship. I want you to be my go-to that I can send people to. Will you just vet them for me so we don't both go down a road we don't want to go?
That's it. 100%.
That's how you're going to win the day. Julie, tell me a story real quick.
I was just going to say, in terms of lenders, if you've had nothing but bad experiences, which, if you're in your first year or two of transactions or real estate, talk to other realtors and ask them who they use, because realtors use lenders, and especially if they've done a volume of transactions, you're going to have 1 or 2 or 3 lenders that are your favorites, and they're going to have the right answer, because you really need to have a lender as a partner. I have a quick question for Jason. What are you seeing in terms of trends in terms of applications, trends in what buyers are doing, trends in their understanding of what they need to do based on what the market, where we're at right now with prices and interest rates?
Yeah, it's ebbs and flows from a application standpoint. I was telling John, there'll be a month where my phone doesn't stop ringing, and there'll be 3 weeks after that where I'm checking if the battery is charged.
Call your own number to see.
So there's ebbs and flows to that, but from a trends perspective, and this kind of goes back to making sure that your buyers up front know what they're dealing with. Is they may have a preconceived notion what their payment is. The special sauce is really making sure they knew exactly what it is going to be within a certain margin. Because again, going back to that $500,000 mortgage, if they expect it to be $3,000, I tell them it's $4,000. Those people are potentially just going to go, hey, let's hold off. So it's really a matter of keeping in contact with those folks who are waiting for that rate to come down. But it's just, again, it's all about communication. That's my main thing. But in this market, you can work very, very, very hard, and your phone's not going to ring as much as the work that you've put into it.
But if you don't work hard,
if you don't work hard,
it's not gonna ring.
when it does turn around a little bit, you're not going to be the beneficiary. So I've been really banging the gavel on the folks who work for me. Hey, be out there, because you might not be getting that phone call tomorrow, but you're going to get that phone call 6 months from now.
Okay, Bianca, hold on, Jay. Is there an increase in new home construction? Have you seen anything like that on the lending side?
So new home construction is really, from a standpoint,
so we need inventory.
We need inventory. The new home construction is generally moving better than the existing construction.
Are they buying down points or something? Or they have
so a lot of the new construction, there's 2 benefits to that. A, your insurance is going to be cheaper on new construction generally. And B, a lot of the larger home builders have incentivized the buyers from a standpoint of buying down interest rates, paying all closing costs, those kind of things that make it more desirable from at least your initial investment perspective, as well as your monthly payment perspective, if they're buying down the rate permanently.
Cool. Real quick, we're bumping up against time here. If you want to win the day, go out after this, write down, think about who you did a deal with that the lending was smooth, easy, you liked. Write that person down, reach out to them, the lender, and just tell them your situation. I want you on my team. I want to be able to count on you. Are you up for it? And away you go. Is that sound fair?
The lenders would love to have that phone call.
And if you're local, Jason's a good guy. He's doing one of ours right now. Love that. And if they have questions and you want to reach it, can you do a loan? Would you do a loan for, somebody in Salt Lake? Is that crazy?
I can do a loan basically anywhere in the Southeast United States.
Southeast, okay.
Yeah, Southeast, from Texas to North Carolina and north to Tennessee.
All right. So there's Jason's info. Reach out to him. Is it all right to email you questions or something?
Email me, call me. I am, one of the things I love to do is make sure everybody's well educated. I mean, that's what it really comes down to.
Yep. All right, there you go. Anybody have one last thing to say real quick?
I think the big takeaway is when somebody says, I'm waiting until after the election, say, that's a really great idea. I hear it a lot. I was talking to a great lender who just made the point that that's really handled by the feds, and it's a non-political decision. I think we're going to see things not shift as much. Let's go find the right house now.
Love it. Destiny, you got any last thought?
The last thought for me is when you're meeting with the lender, I like to go out and have coffee with them and really learn what they have to offer, you know, as far as what they're going to bring to my buyers. So I've got two, and I just decide, okay, I think this guy's going to be the best fit for you, or this girl's going to be the best fit for
Sure.
you.
Yeah.
But going in and interviewing them myself to make sure that I'm working with a good team as well.
Give me a call when you get back to town.
Julie, take us out. What do you got?
Same thing. Talk to other realtors, talk to lenders you've worked with in the past. Make sure you have a number on your team. But the other thing I would suggest is having a lender with you at open houses and events that you're at, buyer seminars, that sort of thing, that can answer questions in a non-confrontational kind of way. Then people can find out whether they qualify for a home. I also have lenders do pre-quals or scenarios, I should say, on the backs of flyers at open houses that say, this is what it's going to cost to buy this house.
Win the day, people. Work works. All right, there you go. Let's go to work. We'll see you all tomorrow. All right. Bye-bye.
Bye,
Thanks
guys.
for having me. Bye-bye.
Thank you.